Hello value investors, thank you for joining me. We're going to talk about Okta and why I believe that Okta is overvalued. So we're going to talk about its revenue growth rates. We're going to talk about this whole theme of the digital acceleration. Then we're going to bring this all together and talk about its valuation. If you haven't done so already, don't forget to check out my marketplace where you can do a totally free trial to see if you find stocks that suit you. So you can find high growth stocks with high multiples and low growth stocks with low multiples. So let's get started. The thing that I wanted to address right here is that we can see that starting with, remember that Okta's fiscal 21 is now happening. So it's not a calendar, it's a fiscal. So fiscal 21 is now on and starting, and at the end of next week, there's going to be their Q3 report where they're going to talk about their guidance for Q4. So in fiscal 20, which is last year, they were growing at approximately 46% year over year. Okay, so that's the number to remember, 46%. And then as we have progressed through fiscal 21, there's been a very slow tapering down of its revenue growth rates. So I question whether this whole movement towards the cloud has not actually brought forward some pull in terms of revenue growth rates, and now there's like a gap to fill. Because what investors are doing right now is that they're paying a large premium for certainty, but I'm not quite sure that the certainty is here. So a few more things I want to discuss. So we already touched about that the revenue growth rate is going to slow down slightly going into next quarter, and the analysts following the stock, the street is practically expecting revenue growth rates to come in approximately 33% to 30%. So this is no longer a company that's growing at north of 46%. That's gone. So this is what I want investors to bear in mind. There is a growth rate here of approximately 30%. There's some question marks around that, but this is the type of growth rate that we should be looking at. The next thing that I want to talk about is that there's this whole theme that there's been a pull, an acceleration in the digital world, and that there's a movement from companies that have been on-premise and they're going to move towards the cloud. But I'm starting to question whether that's actually taking place, because we saw from last week when Workday reported their results, although the subscription revenue growth rates were raised, the stock still sold off close to 10% at one point. So even though the company Workday in this case reported raised guidance, the stocks and they beat obviously on the top line and the bottom line, the stock still sold off. And I say why? Obviously because these companies, it's very much about the billings, right? So if the billings are high, which they have been in the case for Okta, you can pretty much recognize that through the income statement, and you can guide the street so you can leave yourself enough of a low bar to cross. So it's very much down to the billings. That's really what the story is all about. And the billings for Okta right now are still quite high. But I want to just remind investors that even if you're beating the guidance and you're having a very strong guidance for the next quarter, the street is kind of starting to be a bit discerning right now. So also last month Microsoft reported as well that customers are starting to have some macro uncertainty. So this is starting to be this kind of detachment and discrepancy in SaaS stocks. Some SaaS stocks are being priced at close to 22 times forward sales, and they're kind of reporting guidance that gives you visibility into next quarter, and they're growing at quite, let's say, 30%. But in the case of Okta, it's the reverse. Investors are paying more than 30 times forward sales, but the revenue growth rates are starting to decelerate. So there's this mismatch that I'm questioning right now. So another thing, that let's just take some back of the envelope calculation, right? Let's say that it has an amazing finish of the year, that it reports at the end of next week that its guidance is going to come at approximately 805 million for the year. And let's say that once we get to the end of next quarter, that they report their guidance for the full year ahead, and they have an impressive year, that they have visibility of 30%, and that the revenues for next year will come up as 1.5 billion, 1.05 billion. So investors right now are paying more than 30 times forward sales. It's quite a large premium to extrapolate the revenue growth rates, which are simply not there. So on balance, I just question whether it's a case that investors are so motivated and have such warm fuzzy feelings towards this stock, because the stock has been quite a rewarding stock. It's up more than 100% since the start of the year, but I question whether investors are not kind of pricing in too much of its future potential ahead. So as always, don't forget to check out my marketplace. I'll tell you which stocks I own and why, with balanced argument for the stocks I own. So thank you for listening. See you next time.